Hey everyone, welcome back to the REI Marketing Secrets podcast. Today on the show, we have Grant Reaves. Grant, for our audience out there who's just learning about yourself and your company for the very first time, do you mind going into a little bit about your background?
Yeah, for sure. Thank you for having me on today, Trevor. So, my name is Grant Reaves. I am the managing director and co founder of Stoic Equity Partners. We're a commercial real estate investment firm based in Daphne, Alabama, which is kind of near Mobile, down on the Alabama Gulf Coast. We primarily invest in multi tenant flex industrial in the Southeast. We have a value add strategy that we perform on those deals. We have also done a few self storage deals as well as a little bit of development, but primarily we buy value add flex in the Southeast is kind of what we do. Jeremy Friedman and I started the firm in 2020. We were both commercial real estate brokers prior to that. And we're longtime friends, and kind of through COVID had a little bit more time to get together and start talking about putting together the framework of starting our own firm. And through that, Stoic Equity Partners was born. He had a deal that he was looking at and didn't fully know how to structure it. And I was looking at starting to do my own syndications at that time as well. So it was kind of just good timing to for us to start talking. And so the first deal that we did was actually the building he had an idea on, but it was a 45,000 square foot office building that at the time the plan was to go in and get the office tenant to renew their lease and be able to flip out of it for a lower cap rate. That was about the time when COVID started. And so that did not come to fruition. And instead, they paid us a big check to get out of their lease, and we turned it into self storage. So that's kind of how we got started.
Oh, that's
Um,
super interesting.
yeah. And so from that deal, we've gone on to do, I guess, a total of 13 investments through syndications or funds, and own about, I guess, right under $90 million worth of assets, and have done about, I guess, 900,000 square feet.
Wow, that's a good chunk of property. But just curious, there's obviously a ton of different asset classes in real estate. You could have your like you guys your flex industrial. You could have your multifamily. You could have your mobile home parks. I mean, there's any number of asset classes. What drew you to this particular asset class over the other asset classes?
Yeah, so we kind of fell into self storage a little bit, primarily just based on that first building. We didn't really have, we didn't start out to be like a multifamily fund or self storage firm or whatever. We kind of just found that first deal and had a really good basis in it. So ended up in self storage that way, and did a few more deals in self storage. Did a total of four of them for, I guess, about 200,000 square feet over four assets. But we pretty quickly saw that storage was getting a little tight, and there was just so much supply that had come in on the market, especially in the markets that we play in that are kind of the Southeast growing markets. And everyone kind of saw that play as like either you were in housing or you're in self storage, but those were kind of what people were building at that time. So I guess in early 22, we started to see that trend kind of get to the point where, like, I mean, I think the self storage is a good asset class and it will do well, but for us to be able to scale and scale quickly, we needed to be able to run, and we couldn't really do that in self storage. It was hard to make numbers work, and then they started upping interest rates, and it just for us became next to impossible. So we really started looking at just what are the other supply constrained markets, because that's really the biggest thing with real estate. Just like any investing, it's supply and demand. And flex industrial, we just knew from our brokerage days there was just not a lot of office warehouse around available for that smaller, say 3 to 10,000, or really 3 to 5,000 square foot user of an office warehouse suite. And then the more we dug into it, we found more and more of kind of the evidence that there just wasn't enough supply to meet the demand. And on top of that, the further we looked into it, you couldn't build the product and be able to make it cash flow at today's construction prices and today's rental prices. So it was kind of just the perfect storm of we'll continue to see rents rise, which is what we're seeing right now. Because if you don't have enough of it already, you can't build a new product, and demand continues to increase as these markets expand. You're just going to have to see rates continue to bump up. And so that's kind of where we are. And so that's how we ended up here. I think that any asset class, I mean, as long as it's undersupplied and it's hard to build new of it, then and it's in demand, then rates will continue to go up, which is where you want to be.
Yeah, and I definitely agree with that. I'm investing in a couple of different deals, and I'm in a multifamily deal, and I'm in a triple net lease deal, and not that it might be exactly the same as flex industrial, but I like the triple net lease opportunity. At least for me, stable cash flow. It's and the one I'm in. It's not a value add deal. It's just your corporate grade A tenants. You could think like AutoZone, Dollar General, those different types
Yeah.
of tenants. But I like the stable cash flow aspect of that play. But curious, when I'm looking at like a multifamily deal per se, a lot of the times it is value add, and it just makes sense. You
Mhm.
look at it below market rents, units haven't been updated in 10, 15, 20 years, however it may be. It makes a lot of sense on that end. When you're doing a value add deal in the flex industrial space, what does that sort of look like on that end?
It's pretty similar to multifamily, really. It's a lot of legacy owners that you're buying from, so it's kind of similar to that I guess C to B kind of multifamily value add play. So a lot of stuff that you're buying is say legacy assets from owners that bought it in the early 2000s or 90s, and their basis is so low that their rents are. I'm just using examples here, but $4 or $5, $6 a foot. Markets anywhere from 8 to 12. But it's going to require a few $100,000 of renovations or $500,000 of renovations to be able to get to market rent. They don't want to come out of pocket. They might have the asset paid off. They don't want to come out of pocket to go renovate this property to be able to bump up rents. But for us, we'll come in, buy it with the construction loan, have that renovation money built into our model, and go ahead and do those renovations, turn over the rent roll, and be able to get it to market relatively quickly. That is the nice thing. What we do is because it's so supply constrained that you do have pretty good tenant retention. I mean, it is a hard conversation when you go in there and you have a tenant that was at 475 a foot and you're taking them to 850. That is a tough conversation. But also at the same time, if the market is 850, like it is in that example, it's kind of like, hey, you can either pay us 850 and not have to move, or you can move down the street for the same space, have to pay to move, and still pay 850. And so it's a pretty easy sell on that side.
Yeah, that definitely makes sense. And
Yeah.
it's just crazy to me how many mom and pop owners you find. Whether it's multifamily, whether it's flex industrial.
Yeah.
I'm just thinking of like I'm in a self storage deal, and it's like they haven't updated like the prices in like 15, 20 years. It's just
Yeah.
like I think it's like, I think the people are paying
It's
like
crazy.
for like a 10 by 10 unit like 30, $40. And I don't know what it is in Alabama, but in New York it's like that's that's insanely
That's crazy.
that's
I mean,
insanely
even in
expensive.
Alabama, which is definitely not New York, a 10 by 10 still for a decent facility is 90, 100, $110. I mean, that's still a big delta there.
Yeah, it's pretty crazy to see. But curious, how's the business been since you started back in 2020? And I'm just thinking about it from like a multifamily lens where a lot of folks got crushed, and you could look at it. They had 80% LTV, they had the floating cap rates, more took on quite a bit of bridge debt, and like you could
Yep.
just see like now, looking back, you can see like okay, these were the problems where it occurred. But how's your business fared since like the start of the pandemic, and obviously with interest rates rising? I don't think anyone expected it to go as quickly as it did. But curious how
Mhm.
your company has handled that and the rising rates.
Yeah, it's definitely been interesting. So we did our first deal. So we started the LLC in 2020. Jeremy and I were still brokers at the time, so we didn't start actually doing deals. I guess we closed that first deal July of 21. So we've been doing deals for just under 3 years now with Stoic. But very fortunately, we never took out any floating rate debt.
Mhm.
We always fixed everything. We saw a lot of risk on that side, and obviously that's about the time where they started upping interest rates. The yield curve inverted, and so there wasn't really a huge offset to float it. So I mean, you might be getting 6% floating versus a 6.5 fixed, and it just wasn't worth 50 bips of benefit to take that risk to us. So we've never floated any debt, which has been monumentally a great move looking backwards, obviously. And then it has become just more and more difficult to buy stuff, though. I mean, I think that's the biggest thing is that there are so many owners that have long term low interest rate debt. I mean, it's no different. I was talking to my wife about this the other day on our personal home, kind of a side story, but we have like a 2.75% interest rate. And I'm like, I'll die in this house or at least keep this house forever, like, and so you look at that, and even on the commercial real estate side, right? There's so much inventory that has been taken out of the market just because all these owners have such great debt in place fixed that until we start to see that turn, it's going to be really interesting. But fortunately, not being a multi really helped not get crushed as bad, just because I feel like the multi product, the fundamentals are definitely there. They're still there for housing. America's undersupplied in housing, but at the end of the day, that model of floating bridge debt to be able to get to agency or HUD, just it got on the wrong side of the trade, which is a shame. But I think long term that most operators will come out the other end okay, but it will be interesting. But on us specifically, going back to that, really the biggest thing is just deal flow is hard to make work. You have to get very creative on how to structure deals, how to be able to put them together, and also just talk to a lot of owners. So we have really good analysts that talks to a lot of owners, a lot of brokers, just to go through a lot of deals, because you still have a lot of people out there that they would love to sell. They're going to sell at a 6.5 or 7 cap, and maybe stabilize year 3 yield on cost at 8. And if your debt's 8.25, 8.5 fixed, this just doesn't work. I mean, you can't stabilize to negative leverage, right? Like you need to be able to stabilize to 10, 12%. So that is really the hardest part of the rising interest rate environment for us.
And I like that aspect, at least, even though if it's harder to find deals, you're at least vetting these deals and taking a lot of time to go through them.
Mm-hmm.
And I found just different operators within the space where it feels like they're almost having a new deal. Like it's almost like once a week. And you're like, did you actually vet this deal, or are you just doing it to
Yeah.
get the acquisition fee? And I'm perfectly fine. I'm happy to pay an acquisition fee. And I
Yeah.
know all that goes into it. But it also just scares me sometimes where it's like, okay, you found another new deal you're raising again this week. And not to say like they're not a good operator, it just scares me sometimes. I just wonder like how good did you actually vet this deal? So it is good to hear that you have a good team of analysts going through and checking out these deals. And
Yeah. And
with
we have started to track that actually. We put that like in our monthly newsletter and
oh
stuff. Is
wow,
like how many deals we reviewed, how many we underwrote, how many offers we made, how many deals we actually put under contract. Because we had LPs come to us and ask us the same question. Because a lot of times when you're reaching out to LPs, the only thing you're talking to them about is like, hey, I have this new deal. So to them, even if it's not every week, so let's say it's every other month, which isn't a ton, but it's a lot, then if that's the only time you talk to them is you have a new deal every time you talk to them, that it's going to seem like to the LP that these guys just are just taking everything that they can. But then when you start to peel back the layer and you start to show like, here's all the deals that we looked at, here's all the ones we underwrite, here's all the deals we made offers on, here's the ones we bought, and kind of show that funnel, it definitely helps. We actually had an LP who had an exit from a company, so he had a little bit of time and just liked real estate. So he started like poking around on LoopNet and stuff like that, and like trying to help us find deals, which is great. It's just helping out. But every deal that he would send us, I'd be like, we've seen this. This is why we don't like it. This is why we didn't make a run at it. This, that, and the other. And it took him about a month to finally be like, all right, so if I find anything, y'all have already seen it. And I'm like, we try to think so. It's like you got to stay on top of that. But no, I totally agree with what you're saying, and it is one of those where you want to be careful not to look like you're not really vetting those and really digging deep into them. Because that's a big part, right? Like everyone can scale really quickly. It's about being in the business 10 years later, not today, right?
yeah, exactly. But I'm curious on your deals themselves that you're finding, and you're going out there when you're putting together. Let's say you're raising capital for the deal, 25, 50, 100K, whatever that number maybe. Is it more of a single asset allocation where it's just say one flex industrial building, or is it you're finding one in Alabama and then your other markets that you mentioned earlier? Is it more of a fund model, or is it more of the single asset allocation, or is it just like a mixture of both of those?
So it's actually both. So we started off just syndicating. So the first 10 deals that we did were just true traditional syndications where it would be a single asset, $50,000 share prices, and just raise from there. I guess Q4 of last year, we did start a fund, which is just a flex industrial fund aiming to raise 25 million. We've raised 7.5 in that vehicle. And so what we've kind of done with that, though, I don't know if this is unique, but it's worked really well for us, is there are certain investors that like funds, and then there are some investors, especially larger investors, that prefer single assets and like directly investing in something. So what we've done is taking the fund and let the fund invest a portion of the capital and then bring in pari passu direct investors into the same deal. So it kind of can offer both of those, and it keeps the cash flow the same because it all just splits down pro rata. But that allows the fund investors to get involved in maybe bigger deals that would over allocate, or maybe if we don't have the funds raised in the fund yet, to be able to take down that deal. And also it gives some of those investors the ability to be able to go directly into a deal, because that is an interesting thing. And it does seem like sometimes the smaller check writers, like I said, the 50 to 200s, which are great, and like we love the smaller investor, but like a lot of those guys, maybe they only have $50,000 to invest in private real estate, period. Well, a fund was probably a better fit for them, right? Like you can diversify risk, you can diversify your opportunity, go out geographically. But a lot of the larger kind of fund to funds and or larger family offices that are writing $1 million plus checks, they really want to see that single asset, know exactly what they're investing in, and go directly into that one deal. So it's kind of good to be able to have both, to be able to offer everyone, right? Because I mean, this game is as much raising equity as it is real estate, and so you don't want to pigeonhole yourself, I feel like, in one or the other, into a situation where you're like, well, we only do funds. We understand that you want to write a $2 million direct deal, but we don't want to, we're not in a position to turn that away. Some other operators might be, but we like to make it work for however people like to invest.
Yeah, no, that definitely makes sense. And I've spoken to a lot of different sponsors and operators, and I don't think I've heard of anyone doing it that particular way. Usually it's just one or the other. Either it's a single asset, whether it's just the fund model. So I, that does make a ton of sense because I mean, if someone's coming to you and they say, "Hey, I want to get into one deal," and I have a $2 million check, it's not like you want to turn them away if they like what you have to offer. So that makes sense on that. And then when it comes to like the typical return someone could expect, is it again, I'm just spitballing, I'm just throwing numbers out there. Is it like a 12 to 15% IRR, maybe 8% preferred? Just what does that look like, or does it vary? Depending on, let's just say you had like again just spitballing like income fund one, and then you close that deal, then you have income fund two, or
Yeah.
how does that look like on your end?
Yeah, so the fund's target overall is a 15 plus IRR net to the investors, average cash on cash, and quarterly distributions of 7 to 8%. Now, it's a value add fund, so your first couple of years are going to be more in like that 4 to 5% range. Your last couple of years are going to be like 9 to 10% range, and that's going to average back into that, say, that 7.5 kind of range. On the single assets, it can be a little bit more varied. We've done stuff, just think of the last three that we've done, that the fund actually has investments in, but we also have direct investors too. We have one that's just over an 8% cash on cash return average throughout the life. So it pretty much starts paying dividends immediately. And the total IRR on that deal, though, is around 14. And then at the same time, we have a deal that is a 5% cash on cash, but like a 23 IRR. And the first 2 years are 0% cash on cash just because it's such a large value add. So those are kind of the two ends of the spectrum. So like a 8 and 13, 14 IRR, or like a 4 to 6 and 20 plus IRR, and any variation there between.
Yeah, that's perfect. I think that's definitely good to know. And then for those the members of the audience that are interested in what you guys have to offer, are you guys accredited, non-accredited? What is that? Or taking accredited,
We're
non-accredited investors?
we are all accredited.
All
We
accredited.
don't take any we don't take any non-accredited right now. We'd like to figure out a vehicle maybe one day for that. But just for the laws and the red tape, it just makes life a lot easier right now just to take accredited. And then so that's how we do it.
Yeah, no, that's definitely good to know. I always it's always sad, not sad, but when someone like I come across deals, so I'm not accredited myself. So like when I come
Yeah,
across deals I want to invest in, I'd rather know beforehand whether they take the accredited or non-accredited because I've been on, and that's like usually when I'm talking to a sponsor, like the first question I'll ask because it's like I could fall in love with your deal, like what you have to offer, but if you don't accept, not that you don't accept me, just the way you structure your deals,
yeah.
that I always like to know ahead of time. But to circle
And
back real
hopefully
quick,
those laws will get easier over time on the non-accredited, because I do think that private real estate investing is a great investment tool for anybody, and I think that it's silly to alienate that much of the population personally. And so I think that like I said, like we would like to start taking more accredited, non-accredited investors and be able to have a better vehicle for that, because that's definitely a need in the marketplace, and definitely a lot of potential. I feel like in a lot of places that we could help a lot more people.
then it's been frustrating to me because like I'm in 4 deals and like I had to vet a ton of sponsors, had to do like a ton of due diligence. I mean, I get the protections there because you don't want someone just like blindly like, hey, here's 50K of my money without knowing what they're investing in. But it's still frustrating. I think the SEC was working on some sort of test you could take to pass it, and there's some I could go through and I could get like a Series 65, go through that
Mm-hmm.
whole process. But I'm like, I don't know if I want to do that. And there's a company that does it, but you have to pay like $500 a year, and then they'll set you up as like an LLC through or however they do it. So it looks like you're actually running a company, so you can always renew your. I think it's your Series 65, so that way you can be
Yeah, I
accredited.
think
But
if you're either a 7 or a 65, I think that's accredited.
yeah, yeah,
Um, but yeah,
yes, that one's interesting. But to me, it was just like I don't know, the $500 just eats into the returns, especially on the returns where my more aggressive deals, like you mentioned, I'm getting like 4 to 5% the first couple of years. I don't, might be $200 a deal. To
yeah,
kick off 500 for the year, it eats into a little bit. But yeah,
for
curious
sure.
when it comes to these deals themselves. I know you mentioned like the tenants, you come in, you have the value add process where maybe you bump up, 475 a square foot to 850 or whatever that number may be. When it comes to like the lease term, and I'm just thinking more so from the triple net lease side, like we're coming in 5 to 6 year leases with these corporate grade A tenants, built-in rent increases. Is it similar on that side? Are there shorter term leases, longer term leases? What does it look like, or is it more just vary by location?
Yeah, it's usually more 3 to 5 year lease terms, and they do have annual bumps. So most markets right now we see 3% bumps. The Atlanta metro, you can get more like 4 or even 5% annual bumps, but for the most part, we see 3% bumps is kind of market these days after the inflationary process we've been in the past couple of years. They are triple net leases, most likely. I mean, we do own some that are modified gross facilities, but for the most part, you want to be triple net leases. And yeah, I mean, we have corporate grade tenants, but we also have a lot of kind of local or regional kind of like HVAC company or like a general contractor or something like that as well. So it's kind of again, but then also we have like Terminex or Tyson Foods or FedEx or like those kind of larger tenants as well. So it's kind of a very wide range of your tenant base, which is great because it also makes you not too heavily sectored into one asset or one sector, right? So like if construction completely goes away, that would hurt our business obviously because we do have a decent amount of construction tenants, but it's not 100% of them. So you still have other ones that you can kind of lay that risk off on by diversifying out your tenant base.
Yeah, I think there's a ton of different interesting tenants out there. I know in the deal I'm in, we have like a vet office, which is interesting.
Mm-hmm.
It's crazy. You think it's like your local mom and pop vet office, but then they're owned by like this $1 billion corporation. You know, a private equity firm came in and then bought like your local vet office. But I mean, they keep it the same vets there, the same name. It's pretty crazy. I think near me, I saw about a year or two ago, this guy. I don't know how he did it, but he was offloading a portfolio of buildings where the post office was being rented out. So
Mm-hmm.
that was pretty interesting. Where he owned like 10 or 15 buildings where the only tenant was the post office. To me, that
Yep.
just seemed too risky because who knows, if the mail's gonna. I know they always have funding issues where they might,
Yep.
cut back how much they deliver. But I thought that was like an interesting portfolio where he only owned post office buildings are renting out to those tenants. But let's say someone is listening to this conversation and they like what you have to say. They're let's say they are ready to invest and then they've invested in the deal. What does that communication that's from the communication standpoint look like? Is it monthly reporting? Is it quarterly reporting? Is there just curious what someone could expect after they were to invest with your company?
Yeah, so it is quarterly reporting. So we show kind of our typical quarterly update will be recent pictures of the property if we did any renovations recently, kind of showing what we've been doing. A page that's kind of going through here's what the leasing activity looks like, here's what the renovations we've been doing, here's some tenants that are not renewing or are renewing, and kind of just an overview of what's happening. We then show NOI, revenue, full rent roll, P&L, balance sheet of each investment. And then, like I said, they're sent out quarterly. So we always make sure to send them out. Like right now, it's April 9th, I guess we're filming this. So we will get out all of our quarterly for Q1 by April 30th. So
Hmm.
the reason for that is we use third-party property management. So we don't get the property managers financials for the prior month until like the 20th of the month. So then it gives us like 10 days to be able to go through, put all that into our forms, upload them we use Juniper Square as our investor portal and put it up into Juniper and then be able to send it out to everyone. We also distribute quarterly for cash flowing assets. So we do directly through ACH payments. Is kind of how we do that. We always make sure to be very transparent and very available. We my personal cell numbers on everything, my personal emails on everything, and so is Jeremy. So if anyone is an investor of ours, while they do only get quarterly, we're also always available if somebody sees something or has a question or something like that. We always make sure to be very accessible because obviously if someone is a investor with you, they need to be able to contact you really easily and
Yeah.
get back to you very quickly. So we make sure to not have any layers of protection there or anything like that.
Yeah, and I really appreciate that. There's been times where not so much deals I invested in, but talking to different sponsors, asking questions about their deal, and asking them a question, and they get back to me like, 2 or 3 weeks later after the
Mm-hmm.
fact, and it worries me because I'm like, hey, if I'm going to be putting 50K into your deal, and I can't get, and I'm not like my expectation is, hey, can you get back to me within like 3 to 5 business days? I understand you're busy.
Yeah.
I don't need to be back super quick, but I would like an answer. And there's been times because like at least for me, I'll underwrite all the deals myself when I'm looking at them just to make sure they pencil in, and then I'll have questions from there. Sometimes I just won't even get an answer back, and
Yeah.
that definitely scares me and turns me off as a passive investor. But Jeremy, I
Yeah,
want
and I'm sure that there's somebody listening to this saying that, and I'm sure that someone fell through the woodwork, unfortunately, at some point, and I probably did not respond as fast as I should have, but that's definitely something we try to stay on top of when we use CRMs and that kind of thing to make sure that people are getting responded to and that kind of thing. Because It is interesting, right? Like you start off your firm and you're reaching out to everyone because you know
Mhm.
them all. It's all friends and family. And then when that tide starts to turn and people are reaching out to you, um, you do want to make sure that everyone's getting that attention and everyone's questions are getting answered and getting answered fully and that kind of thing. So that is something that we're putting a lot of emphasis on right now, just to make sure that there is a point of contact and people know who to contact and make sure that those people are getting responded to.
Yeah, that's definitely perfect to hear. But Jeremy, I want to say that I really enjoyed this interview today, and for our audience out there, if they want to learn more about you or learn more about Stoic Equity Partners, where should they go to?
Yeah, so our website is stoicep.com. So it's STUICEP.com. My email is greaves, so GREAVES at stoicep.com. And I'm also on Twitter as Reeves _ Grant. But yeah, any of those. I'm also on LinkedIn. I do not know my LinkedIn handle, but you're welcome to search me there. I'd love to connect with you on LinkedIn. And yeah, those are the best ways. But email is definitely the easiest way, or through, I think we have a contact us kind of page through our website as well.
Awesome. I'll make sure to include that in the show notes of today's episode. And again, thank you so much for coming on.
Yeah, thank you for having me.